Hi, good evening, everyone. This is Keith from Investment Moats, and today I'm going to cover a topic that I think some it might be familiar to some of my readers, might be familiar to you on YouTube who is searching for something to regarding this safe withdrawal rate system. This is a topic I think more tuned towards retirement income or financial independence income planning. But I think for those people who are interested in investing and what's the end goal of investing, uh, you might be interested in something like this. Now, the topic for today is what I call it as what is the safe withdrawal rate spending system. And I think some of you might have heard of this thing called safe withdrawal rate, but perhaps what you might be more familiar with is this term called the 4% rule. It is something that is very often talked about in the financial independence planning community, and I think it's something that people use to actually determine how much retirement income that they need or how much capital to build up towards. So it is something to them very simple, but I wanted to do this video because I realized that a lot of people have a lot of different understanding about this 4% rule, what's a safe withdrawal rate system. And I think a lot of times, right, people have the wrong idea. I've talked to enough people, whether it's readers, uh, even my colleagues back in my wealth advisory firm, right? I just sometimes when we have a conversation with them, I know that okay, they have a misunderstanding here and there. So I wanted to do this video once and for all to just focus on the person who created this, what is it about, and also try to answer some of the questions around it because sometimes to understand it is also to understand what it's not. And so I think let's not delay anymore. So okay, let's go to the slide. All right. So we always start off with the financial problem. What is this safe withdrawal rate or this safe withdrawal rate spending system supposed to solve? And I think why it's this safe withdrawal rate is very appealing is because it solves a very niggling financial planning problem out there, and in my opinion, better than a lot of the other solutions. So the problem is something like this. I think this is the main problem. A lot of people are planning towards whether it's a retirement or semi-retirement, financial independence, providing income, and all. Wait, let me change to the laser pointer a bit. Hopefully you all can see it. Let me just keep my OBS here. Financial independence or financial security or providing some income. Basically, you have an income needs. And it usually looks like this illustration over here. You start somewhere, and you hope that within this time frame, right? Usually it's like how long you're gonna live, right? To be able to have income for your needs, whether to provide income for basic needs, income for all your needs, or just flexible income. So the idea is you have already accumulated a pot of gold, and then you're supposed to like spend it down, but you want the money to last as long as possible. So the 4% 4% rule or the safe withdrawal rate framework, right? It's to address this problem. Now, a slight modification to this problem over here is something like this. Most of us, we don't start off with capital or some amount of money that we can spend down. So we are also looking towards building up to this bigger capital base so that eventually we can spend down. So this is an extension that I think most of y'all are at. You're trying to accumulate. Maybe your inside your head, the idea is like $1 million, and whether it's 1 million, 1.5 million, or 500K, right? It's a question mark in your head, and this is what you are trying to solve. Okay, so how does the safe withdrawal rate solve this problem? Okay, so the safe withdrawal rate, what is it? It's actually a very simple percentage figure, right, to help you figure out, right, how much you can spend, how long your money is going to last, and what is the asset allocation. So if we go back to this figure over here, right, it's like how long is this period? Okay, how long is this period? How much exactly? You see, there's no dollar value over here, right? How much you can spend so that your income can last this period. Okay, and of course, I think the important question is how much do you need, and like how do you structure this thing? So just a simple percentage figure, and it's able to try to resolve something like this. Okay, because it's a one percentage figure, right? The safe withdrawal rate framework, right, provides something that really simplifies planning. And I think later on I'm gonna show you like roughly how simple it can be. Okay, and I think safe withdrawal rate might not be something that you're familiar with, but I think the most prevalent safe withdrawal rate is this thing called the 4% rule, a 4% safe withdrawal rate, right? And this is derived by the person who actually like kind of started this started us down this rabbit hole called Mr. William Bengen itself. So the percentage is something like that. So you can imagine that the safe withdrawal rate is made out of it's a simple ratio lah, and the way to calculate is that you're taking your annual income or expenses. Why is it income or? Because conceptually, right, or in actual practice, right, it's kind of different lah. It can be different or it can be same, because sometimes if we plan to for income of $2,000, that $2,000 is to address our spending needs that is equivalent or less than $2,000. So that's why it's considered income or expenses. And you divide it by the capital required or available. So why is it required or available? It's most of the time it depends on what you're trying to do, which later on you'll be able to see. Now, this is a simple formula, but if you rearrange it, right, you can see how it applies to financial planning. If you're calculating what is your capital required for retirement or financial independence, right, then it is taking that annual income or expenses divided by that safe withdrawal rate. Or if you're trying to find out the income available for spending, you just have to multiply what your capital available with the safe withdrawal rate. Okay, so let's go through some example. So imagine that Keith has like about $4 million, and the question in his mind is that, okay, $4 million looks like a lot of money, and it looks like it's functional for his financial independence need. Now, some of the questions that he has in mind is how much can he spend, how long will his money last, and what is his allocation. Basically, just now some of the questions that I said. So to calculate the income available for spending, right, all we have to do is that you take $4 million times 4%. This is a 4% rule lah. And if you times this together, you have $160,000 a year, which sort of means that I probably have about $10,000 a month for spending. So this formula comes from this one, which is one of the three rearranged one in the previous slide. So it's annual income available for spending equals to your capital available times safe withdrawal rate. So according to the research, the body of work behind this 4% rule, right, we know that this money will roughly last for about 25 years. Okay, and the default portfolio allocation is a 50% diversified equity and 50% diversified bond portfolio. So this is roughly the illustrations over here. So with this in mind, right, like with the body of work behind it, you know that you can apply it, because in today's world, and probably what I covered in my last presentation on crafting a passive portfolio, right, for your financial goals, right? These kind of diversified equity and bond portfolio is readily available for and is scalable for you to actually implement it. So this the simplistic nature also it also shows that you can actually do a good implementation over it. Now, if we frame it another way, right? Let's say right now, Keith wants to retire with an income of $2,000 monthly, right? In today's money, meaning to say, I need $2,000 monthly, right? And this is to cover my expenses of less than 2,000 today. Okay, but I think I would like to retire 15 years from now. Or that most likely I don't have the money right now, but I'll take some time to accumulate, and I think it's about 15 years. So the question is, how much do I need in 15 years time? Like what's the large sum of money that I need? Okay, so the income needed in 15 years, right? The first thing that we need to work out, right, is that this $2,000, right, is in today's money. Okay, how much is after inflation, right? Because when money loses out from inflation, we actually need a larger sum of money 15 years from now. So that's the first thing to actually figure out. So we take $2,000 times 12, which is 12 months, times we usually say it's 1.03, but it's like about 103% to the power of 15. Why 15 is because 15 years. So we try to compound this $2,000 monthly, right, at 3% for 15 years. And we arrive at a yearly income figure of about $37,391. So this is assuming that inflation to be 3% a year. We're using something fixed. And depending on your conservativeness and how you look at inflation, right, you could tune it down or tune it up. Okay. Now that we know that 15 years from now, probably the equivalent purchasing power of $2,000, right, of 24,000 a year, right, is about 37,000, right. We can use this safe withdrawal rate, right, this 4%, right, to actually work out like how much capital that we need. So we take this 37,391, right, divided by 4%, right, and we arrive to $934,775. So this is the amount that, like, over here, if you look at this illustration over here, right, I think hopefully just above my head, you can see it accumulate enough over here. This is a point where you need $934,000. So I have this period of time, right, to accumulate $934,000. So given that I need 934,000 today, right? In 15 years from now, 15 years from now, right? How much capital do I need today to grow to that? So assuming that my investment return is like about 5% a year, like I can put inside a portfolio, and I use a conservative rate of return, right, for this equity and bond portfolios, right, to earn about 5% a year. So with this kind of time value of money formula, right, you take this $934,000 divided by 105%, because it's 5% a year, to the power of 15, right, we arrive to a figure about $449,000. So today, if I manage to have $449,000 and it grows to 5% a year for 15 years, right, I will have this 934,000, right, which should provide me enough income, right, for my needs according to this 4% rule. Okay, Now, of course, these are financial planning math. If let's say I don't have 449,000 today, right, we can also work out like how much do I need to put in from my income yearly, right, in order for me to fulfill this 934,000. So I didn't put the math in, but it works out to be about $43,000 a year from my salary. Okay, so as you can see, most of the plannings, right, you can even cover it in one slide. You don't need some crazy calculator to actually do that. So this is the nice thing about this very simplistic safe withdrawal rate system. Okay. Now, this is a last example. I find that it's also very good because you have this percentage and a certain body of work behind it, right? What you can do is actually Cliff can track his financial independence progress. So let's say I have accumulated $200,000. The question is, what can I buy with 200,000? Specifically, if let's say I yearn to be financially independent, right? I want the passive income, right? How much passive income can I buy with $200,000? So how do we have a good rule of thumb to actually determine that, right? And not have to think about a lot of the nitty gritty all the time. So this is a similar math that you see, I think, in the first case study, where we just take $200,000 from this 4% rule, right? And then we get $8,000 a year. So based on the body of work, right, we know that this 8,000 a year, right, probably lasts for 25 years. We can deploy it eventually, like at any point, right? Maybe now $200,000 in cash, right? Eventually, I can deploy this into a diversified equity and bond portfolio, right? And I can get income for it, but I can only get $8,000. Now, instead of tracking like 200,000, this one is maybe what a lot of us prefer in to track our net wealth. Perhaps it's more meaningful and more useful to track in terms of income. So you can imagine that we create this chart over here. This one is our expenses. These things over here, it shows that these are our expenses, and this $8,000 a year in income. So over time, it's very initially it's very small. Then eventually it grows bigger and bigger. So excuse me. If we track this way, right, eventually the expenses and the passive income, right, will be quite close together. And this is where you know that it's getting closer and closer to your goal. So I find that this is kind of more meaningful. So as you can see from these examples, right, how it marries this safe withdrawal rate system, how it marries to help you, how it marries the problem with the financial plan, right? It can be very straightforward and very very simple, which is one of the main appeal about it. Okay, so who actually like came out with this one? There's this guy called William Bengen, and actually like he has this retirement problem that he thought about in the 1990s. So Mr. Bengen, these are some background information. I wouldn't go into it too much. Basically, he graduated from MIT, but he works for quite a fair bit of time in his family-owned business. But eventually, he sold it off, and he decided to become a financial planner. And that's when he realized that there is a certain financial problem, right? That a lot of people that he tried his best to see whether someone else came up with a solution to that problem, but unfortunately, no one did. So he wrote the paper that gave birth to the 4% rule. Okay, and I think I'll link in this video below. I'll link to his a certain educational portal that links to his original work and some of his past work regarding this, because he a lot of people build on the work. So whether how you look at this Bengen's 4% rule, right? We have to acknowledge that it his research or his framework, right? A lot of people build onto it. There's a lot of debate about whether this rule, whether it's safe enough, is it outdated, or whether in the international domain, whether 4% is safe enough or not. There's a whole body of things. There's a whole conversation. I'll say it's a whole conversation around it, and having that conversations is actually good. It's very healthy, in a certain sense. Like if we talk more around it, right, then we know some of the strengths and weak points, and people can look at it in different light. Now, of course, because it's so simple, right, they also give a glimmer of hope to a lot of people that don't like their job lah, that pursue early retirement and all. So these are some examples that I think most famous is in recent history, like in the past decade, have been Mr. Money Mustache, who actually wrote this article called "The Shocking Simple Math Behind Early Retirement," which is actually based on this 4% rule, and to show people that, hey, if you use this 4% rule to calculate and you can accumulate to this amount of money, you are ready for early retirement. Okay, so. And you can see that there's a whole conversations in the F.I community around this. And in a certain way, we can also build a certain like ladder or a certain milestones, right? To based on this 4% rule of different kind of safe withdrawal rate system, right? To track our progress, lah. To track our progress, like to how deep or how safe is our retirement itself. Okay, so what makes the F.I problem like so hard to solve? Okay, I can spend a lot of time on this one, but I prefer not to. So retirement income or trying to get income from a portfolio, right, is not so simple of a thing. But what makes it so difficult? A lot of people have different ways of actually explaining it, right? I have my own way, and it tends to be more technical compared to what we used to explain back in Provident. Okay, so Bengen himself, right? As I said, he cannot find any research before he embarked on this to solve this problem, and he's trying to answer three questions. How much do I need to accumulate for my retirement? Which means that whether it's 1 million, 2 million, 3 million, what's the amount? How much can I safely spend in retirement so that I do not run out of money? So this is the biggest risk in income planning, is like how do you get consistent income but don't run out of money prematurely, okay? And what would be the ideal asset allocation? And you realize that you cannot look at these three questions independently. These three questions are tied together, which is one of the complexity of this problem itself. Okay. Now, in my opinion, right, spending money in F.I, right, is challenging because of three different kind of uncertainties in life. It's because of these uncertainties, right, that makes planning kind of difficult. So what are these three uncertainties? First one is uncertainty over the duration of income needs. Second is uncertainty over future market conditions. And the third one is uncertainty over your income spending patterns. And because of these three problems, right, what I realized is that the financial firms outside, right, they try to offer, they struggle to offer a solution, right, that deals with these three problems. And because they struggle with that, right, people find that they cannot find a good off-the-shelf product, right, to actually address this problem itself. Okay, so I'm gonna go through this as fast as I can. Okay, the first one is that we don't know how long we will live. if usually we're planning for our FI, right, is that if let's say today I'm about 43 years old, right, then how long would I live? Like you look at this illustration over here, the average life expectancy in Singapore is 83.5 years. But this is of a certain cohort. So for my cohort, probably it's different now. And this is also a probability because about 50%, if for that cohort, right, about 50% of the people, right, they're gonna live beyond 83.5 years. Some is gonna live earlier than that. So if you're trying to optimize, right, to plan for your income, to have enough income but don't run out of money but have enough to spend, right, this is gonna be a headache because firstly, how long are you gonna live? If let's say you start at 65 years old and then you plan all these things and you pass away at 70 years old, you're gonna leave a lot of money on the table. But you also won't know you're gonna pass away at 70 years old. So this is a big problem. Now, secondly, right, this is probably a second point, which is uncertainty over market returns and inflation. So what you can see over here, this one is about returns, and I think if you have seen my videos on the crafting of a portfolio, right, you will realize that returns are a spectrum. So what you can don't look at the text, or you can look at the text later, but this bar chart on the left, right, shows the spectrum of returns, right, for the S&P 500, right, over different 30-year periods, right, from 1926 to 2023. So basically, these are rolling returns. There's about 811 different 30-year periods. So if we roll month by month, there's a lot of 30-year periods. And what you'll notice is that there are some 30-year periods where the average compounded return is like about 7.8% or about 8.8%. There's about 29 30-year periods like that. But there's also some 30-year periods, right, that the return is very good, 13.8% to 14.8%. The median probably for the past, this I think about 96 years or so, is about 11.1% per annum. But there's a spectrum. You're not going to get 11.1%. You're probably sometimes, you can only get probably like one out of all of these 811 different 30-year periods. But which one, 7.8 or 11.8? This is the uncertainty. On the right side, we have something similar, but this is 5-year treasury bonds. And while bonds can be stable during their maturity period, you realize that if we do it over 30 years, right, there's also a spectrum of return from 2.2% to 9.2%. So returns are just uncertain, and this is something that we have to contend with. Okay? Not just returns are uncertain, inflation is also uncertain. So what you see over here, right, is data taken from Singapore statistics, but also US data on inflation. And every point on this chart, right, is a 5-year rolling inflation. Meaning to say, like, if you look at where my cursor is over here, right, which is like about 1.8 or 1 point something percent, right, that means that for that 5-year periods from 1967 till 1971, right, the inflation is 1.9, 1.9, 1.9, and there are certain 5 years period where the inflation is like about more than 9%. That's 5 years, not 1 year, 5 years. So what this chart shows is that actually, like, you can say that the average inflation in the US is about 3%, but is it possible for you to live through a period where inflation is higher than 3% for 30 years? It's very, very, very possible. Okay, so I wouldn't cover the spending portion of things, but that one I think is quite straightforward in the sense that a lot of people don't know what they actually spend on, even today. So how do you expect to really know your spending 15 years or 20 years or 25 years from now. So there is uncertainty over that, and that makes up the third of this uncertainty. So how does Mr. Bengen, right, come out with this 4% safe withdrawal rate? Okay, so Bengen started with a certain kind of assumptions. In a certain sense, he tried to fix something in that we know that longevity is a risk, but there's a spectrum of different duration of income needs, right? You can test, or you can test to see like how much you can actually spend. So he does something exhaustive. So he's using US stock and bond data from 1926 to 1976. That was back when he concluded his work in 1994, which is like about almost 19 years back. It's been some time. So he started with a portfolio of 50% US equities and 50% intermediate government bonds. We got to acknowledge that out of all the financial data out there, US have some of the longest history. But he started off with this portfolio allocation, but he actually tested a lot of different portfolio allocation. Okay, so how do we go about doing this? Okay, so he started with spending, like, if we think about this, right, like how whether your money will actually last or not, we could always start with, okay, let's start with something easy, which is that let's try to spend 1% of a certain portfolio, right, and then see how long this income will last. If let's say we adjust the income with inflation every year, okay, so that's what you try to do. Use something like a very low bar, which is like a 1% of $1 million portfolios, right? And then we move on from there. Okay. Now, what we know that with a lot of financial data, right? Like this chart, right, is a Dow Jones Industrial Average. Of course, it's not using a Dow Jones Industrial Average, but this is actually to illustrate a point. Like with financial data, right, it's not just the price movement alone, but we know that what ties together with this price movement is there's a lot of pivotal events that happens from, let's say, 1900 to 2020, and so together with this price movement, there's also a lot of inflation, different unique sequence of inflation that ties together with it. So with this in mind, right, we can actually like go about testing different time frames, right, over and over again, right, to see whether this portfolio would actually last. So what Mr. Bengen tried to do, right, is you can imagine that, let's say Keith, right, can travel to different parallel universe in the past, right? Each of these parallel universe lasts for about 30 years. Okay? And the question is, out of all these Keith, right, that travels to all these parallel universe, right, and then spending, let's say, 1% of $1 million portfolio, right, do all these Keith, right, their money last for 30 years, or some of them run out of money? So this is the overarching concept, right? What he tries to do. Okay. Now let's go through some one simulation, and I'm gonna switch you to see quite a busy spreadsheet itself. So now I have this spreadsheet over here to actually like try to simulate like what Mr. Bengen did lah. So I shall not go through too much of this information, but I think there are certain parts of it I think you guys might appreciate how it actually works. So let's start off with something I think what Mr. Bengen started off with, which is like let's say we have an allocation of about 50% US equities, which is S&P 500, and 50% intermediate bonds. So let's use, I think, 5%, 5-year US Treasury. So we put 50% in 5-year US Treasury and 50% in S&P 500. Now I have the data from 1928 till 2021. Okay, if year by year, right? So with this information, right, we can actually try to like imagine Keith going into many of these 30-year parallel universe, right, and then see whether the money lasts or not. So we're gonna start off with spending $10,000 out of a $1 million portfolio. So if you take 10,000 divided by 1 million, right, that's like about 1%. Okay, so let's switch to this over here. Now I want you to actually focus on this section over here, and let me try to make it larger so that you guys can focus on this one. So don't look at anything other than this one. This is like just one portion of it, and this one actually it shows how if for, let's say, this cliff that travels to 1928 till 1957, this is about a 30-year period, right? There's a certain unique returns, like portfolio returns, if we're talking about 50% equity and 50% bonds. Okay, so you can see every year the returns are different. Okay, 1928 is 22.42%, then it's minus 2.75%, then it's minus 9%, then it's minus 22%. Okay, but for this period, right, you also notice that there's a unique inflation sequence, not just a return sequence, but an inflation sequence. So for this period, it started off with a deflationary minus 1%, then it's a small 0.58%. Then deflation set in, minus 6%, minus 9%, minus 10%. So we can see over here, like, what's the average inflation rate? It's minus 6.7%, okay, which is lower than the average 3% for US. Okay, we can also see the compounded average growth. CAGR stands for compounded average growth, which is like the geometric growth rates for the returns. If let's say we multiply all this together, it's like about 5.58%. So if we look at the income alone, let's start with $10,000, right? And then for how it works is that we're trying to get inflation adjusted income, or let's say real income. This is so that we are able to preserve our purchasing power. So this income keeps adjusting for the inflation in data in the past year, because cannot be immediately what is the inflation for this year. Usually the data takes some time to come out. So in order to preserve purchasing power, we adjust it for the inflation in the previous year. So you can see the income from 10,000, it drops to $9,884 because last year inflation is minus 1.1%. So while the nominal amount is lower, but because inflation is not running so high, right, your money actually, in theory, right, has more purchasing power. No doubt the amount is actually smaller. So this income, right, is actually deducted from the prevailing portfolio value over here. And the next year, right, we adjust the income, right, based on this inflation over here, which is 0.58%. So you can see that this $10,000 income, right, it just keeps going down and down. But why? Because during this period, right, there is some deflation happening. Okay, so the income is going down, but because inflation is not running so high, right, then by right, even though you have 7,700 for the year for spending, right, that should allow you to spend to buy the same things. Okay, now slowly after this period, you realize that we have higher inflation. Like we have 18% inflation over here, right? then that's when you start seeing, let's say, the income starts picking up to about 8,009, then 9,007, then 10,000, go back, and then it really starts picking up until it at the end of this 30-year period, right? The total income that you can draw for that year is like about 16,000. So hopefully you can see that a few things are the returns, right? It's not fixed. Inflation is not fixed. The income that you draw is also not fixed. But how we determine this one is that this is like real income. Now to the far right corner, right side, right, you'll be able to see like this is a portfolio value. So as you spend income from this portfolio, it also grows based on the returns itself. So for this one, right, after 30 years, right, that $1 million end up with $4 million. So what this means is that in this 30-year period, we spend like about 330,000 in total income, right? After that, we still have 4 million left. So this is from 1928 to 1957. Now let's roll down like 1 year. Okay, what you're seeing over here, right? This one, right, is from 1929 to 1958. Somewhat is a different return sequence, is a different inflation sequence, and of course, like how the income progresses is also slightly different. What we're able to see is that okay, for this period, we're also left with $4 million. Okay, now let's roll one more year. Okay, so this one would be from 1930 till 1959. Okay, another different return sequence, another inflation sequence. That $1 million is left with $4.4 million. Now let's go to the next one. Okay, next one is 1931 to 1960. Okay, $1 million is left with $5.1 million. Okay, total income that you managed to spend during this period is about $376,000. Now, I think in the interest of time, I won't continue all this, but I think you'll get the picture. As you go on further, right, you have different kind of 30-year periods. So this is something similar to what Bengen did, which is like you have it's like this cliff goes through many of these historical periods with a lot of those turmoils and all, right? And then whether does the portfolio last or not. Okay, so you can see that there are some years that is like left with 6.6 million, 7.2 million. But I think you're more interested to see like, do they last for all of these different periods? So let's go over to the summary, right? Focus on this portion over here, right? So this table itself, right? It shows the summary of all those different 30-year periods. Okay, so there are like about probably 65 different 30-year periods, and over here it summarizes what's the ending portfolio value, ending income. So we can see that I'll move slowly to let you see. You can see that actually almost all the portfolios, they end up with $4 million. Some of them is even with, let's say, $10 million, $14 million, $70 million. And the income that you get, right, at the end of it, right, is all much higher than the original $10,000. And I think over here, this ratio, right, and total withdrawal rate, right, it gives you a picture that at the end of this 30-year period, right, if you see that it's 0.4%, 0.3%, right, it means that the income divided by the portfolio value, right, is a very, very small figure, which means that this money will last for a long time. So is this good or is this bad? Now, it's good in the sense that you know that if you go through all of these different periods, right, the money lasts. But it is not so optimized because You don't want to like work so hard and you can only spend 1% of the portfolio. But how much can you actually spend so that to more? Okay, so next thing Bengen will do, right, is to adjust upwards. Let's say I adjust to $11,000. Okay, and then you see over here some of these figures change. But you can see that all of them, they still end up with a lot of money. Okay, and that means that actually spending $11,000 or 1.1%, right? It's not 1.1%, right? It's not so not so abrasive. Then you can slowly increase. So in the interest of time, let me increase it at a faster pace. So let's say we increase to 1.5% itself. If we take a look at over here, right, even the lowest, like the lowest amount, right, is still like about 3.4 million. 1 million still end up with 3.4 million. I think we can push further. Okay, let's go to $20,000 or 2% of the $1 million portfolio. Still a lot of money. Okay, let's push it further. 25,000. Okay, the lowest, you can see that, okay, there's still no negative value yet. Let me push it further. Let me push it to $30,000. Okay, now we can still see that things are okay. Let's push it to $35,000. Okay, now we start seeing some red over here already. Okay, but you can still see that most of these portfolio do last. There's probably some periods where the ending portfolio value is about $730,000, but it's red for certain reasons I will explain later. But let's say let's push it further to nearly 40,000. Okay, now you start seeing these red already. Okay, so let's take a look at, let's say, this sequence, which is a 1937 sequence. Okay, so it's over here. Okay, now you can see over here, right? We start off with 40,000 income. Okay, this one will be quite close to Bengen's 4% rule, because 4% rule means that our $1 million portfolio you spend 40,000. Okay, and the income that there's a unique return sequence. There's a unique inflation sequence. The income started off with 40,000, and if we inflation adjust, right, near the end, right, the income is about $89,000. And but the portfolio value, right, it started off okay, but eventually it starts dwindling down until it ran out of money in the last year. Okay, so this is what Bengen would term as a failure lah, because the money doesn't last like long enough. And this 1937 is one of the tough periods, I think, because of the way the returns, but also it kind of coincides with certain periods where the inflation is starting to become highest. The unique thing about some of these sequences is that you can see that this 1937 or 1966 period, right, this money don't last for 30 years. But if it's just 1 year before that, right, instead of being left with running out of money, right, you're still left with $787,000, and you still get the income. If we go 1 year beyond 1937, we go to 1938 to 1967, right, this 1 million portfolio is left with 1.8 million. This is just 1 year of a difference. So what this actually means is that each of these sequences of returns and these sequences of inflation is very unique in a certain sense. Like it can be quite critical that whether you end up running out of money or not running out of money. Okay, and we know that there are some sequences, right, that is particularly challenging, which is those 1960 something periods. Those are the periods where the US experienced very high inflation. Give me a while. Yeah, so this is a period between that start in 1965 to 1994. Okay, so the income, right, started off with $40,000, but let's look at the inflation itself. The inflation for this period is 5.37% for 30 years. It's not 5.37% for 5 years or 10 years. It's 30 years. So you can see there are certain years where inflation is 12%, inflation is 13%, inflation is 12%, 9%. It's just high lah. So the income needs, right, started out with $40,000 before eventually ending up with needing $186,000. Why need so much income? Because with high inflation, right, in order for you to preserve your purchasing power, right, your income needs to adjust accordingly. Okay? And because of this very straining income needs, right, it actually puts a lot of strain on the portfolio itself. So that $1 million starts dwindling down. Now, some of y'all might be thinking, like, in terms of the traditional planning, right? If my inflation is 5.37%, as long as my returns are more than that, it should be okay, right? You just take a look at the compounded average growth. It's about 8.6%. That's like about 3.2% higher than the average inflation. But you still run out of money. So this puts a certain perspective on average returns and average inflation, right? That like how useful they can be. And probably this highlights, right, sometimes what we talk about negative sequence of return, right? It can be why it's a big thing, because you just look at 1 year before that, right? This sequence, right, they don't run out of money lah, but it's, I think, 1 more year you run out of money already because it's only left with 130,000, and I think the year after that you also run out of money. This period you don't run out of money. So although a few years later, 1967 or 1996, right, you're still left with 600k, but I don't think it's gonna last quite long lah, because you're spending 186,000 and then you're only left with 602,000. Okay, now from this one, right, we know that, I think, based on this simulation itself, right, we can't spend 40,000. And sometimes you might ask, like, hey Chief, it's like still quite good leh. There's a lot of periods where you are still left with a lot of money, and this is something for you to think about. Like, we're not sure what's going to happen going forward, and do you want to take that risk that okay, there are some years where you run out of money, some years you won't run out of money, and it's a question of like your conservativeness, or the lack of conservativeness, and for different people they look at it differently. So if let's say we don't spend so much initially, right, and it's like about 35,000, you realize that excuse me, you realize that you don't run out of money. But of course, if you see that there's a lot of red color, right, it means that slightly after 30 years, you will kind of run out of money. So what Bengen is trying to do, right, is to find the highest income that you can spend, right, without running out of money. So they're trying to, or rather, how I would term it is that the highest income, right, factoring the worst case scenario, because we know that probably for a 30-year period, right, this sequence, these few sequences are some of the worst 30 years periods. And if you spend $35,000 out of $1 million, right, you should be okay. Okay, so we'll talk more around this later on in some of the FAQs. But let's go back to the slides a bit. Okay, so what is some of the high level idea behind the safe withdrawal rate? The general idea is to let you know that due to the uncertainty, right? You can imagine that, I think over here, right, you can see there's a lot of lines. This is a year in spending, and there's a lot of lines over here, right? You can imagine each of those lines, right? Like all of these lines is like keep traveling to a lot of parallel universe, right? In a certain sense, right, like conventional income planning, right, they will try to cover the average returns and inflation. What it means is that they'll probably, based on that, right, they'll probably be able to take care of like your income planning, right, in those scenarios, right, where we experience average to more optimistic kind of sequences, which is these red areas over here. But there are a lot of these kind of more challenging sequences, right? Inflation and return sequences, right? That conventional planning is not able to address. So what the safe withdrawal rate philosophy tries to do, right, is they're trying to cover the worst case scenario, basically. So instead of just the average returns, right, you can imagine the same strands and all. And notice that the difference between these two graphs is that this one is like going below zero already. A lot of these going below zero. This one, the worst one, is above zero. So this is what they're trying to do, to make sure that there is a spectrum of outcomes if we look at uncertain market returns and uncertain inflation, right? And it's trying to cover the worst case scenario. Okay? In terms of, I think, illustrations, right, it is something like this. Like, if let's say you're trying to build this Eiffel Tower, right, and then we know that the average wind speed, right, for that you encounter in for a long period, let's say a long period is 6 miles per hour. So you design this tower, right, to withstand 6 miles per hour. But what happens, but is that a good idea or not? What happens if, let's say, we encounter a once in a lifetime kind of crazy situations that is like 100 miles per hour? Then this tower will crumble lah. So this puts into perspective how conservative should your plan be? Should your plan be take care of all the optimistic scenarios, or should it also take care of those scenarios where it's less than there is more pessimistic? Yeah, this is something to think about. So with some of these safe withdrawal rates, right, we could probably draw a certain table, right? What I've shown you just now is like about 30 years. But with the body of work, right, other people built upon, I think, Mr. Bengen's work, right? And if you look at, I have a simulator over here, right? I could probably came out with a table, right, with, I think, different kind of initial safe withdrawal rate, or instead of the 4% rule, like what is a certain percentage, right, that is the highest income that you can spend, right, factoring all the worst case scenario, and for different periods, right, whether it's 10 years, 20 years, 30 years, 40 years, or 60 years, or even perpetual, right, there's a certain safe withdrawal rate that we can actually come out with. So if we know that we have $1 million, right, like if let's say I'm 43 years old, and then I need probably the income to last for 50 years or 60 years, right, I probably cannot use, let's say, 3%, but probably I have to be more conservative to use between, let's say, 2.8% to 2.5%. So we can have a certain table like this to give you a certain idea, like what's the starting income to spend upon. And other people have built upon the work, and as the conversation develops, right, you can see there are more colors provided to help in your planning, right, in different forms. So this is taken from early retirement now. This guy called Carson, who is like, he used to work in one of the Federal Reserve Office in the US. He has an economics degree, and he's an early retiree. And somewhat also, he out of all the different, for a person as well learned as him, right, he eventually based upon his income needs for retirement based on this safe withdrawal rate system itself. You can criticize a lot of things, but why did he actually like derive to eventually to trust this system? So as you can see on the table on the left, right, we can have different kind of stocks allocation. It's not just like about 50% US stocks, 50% intermediate bonds portfolio. You can try different stocks allocation, different duration, 30 years, 40 years, 50 years, 60 years, and based on different withdrawal rate, you can see what's the success rate. If it's 100%, it shows that, like just now, if you can imagine that just like my table over here, right, 100% means that almost all of them last lah. For example, all of them last. So if it's lower, let's say 75%, that means that there are about 25% of those sequences it doesn't last lah. So this gives you a certain idea that, oh, okay, if let's say you want your money to last for 60 years, about probably a 75% stock allocation, probably it's better for your safe withdrawal rate to be between about 3 to 3.25%. It probably tells you that you shouldn't spend, if let's say you want it to last so long, spending about 4.5% of your portfolio, right, might not be a good idea. Now you also have with all this, you can also like work out like what's the safe withdrawal rate for the, if let's say you want to preserve your wealth, which means that you still want that 1 million at the end of that period. And of course, in a certain sense, right, you have to have enough stock allocation. Can't have bonds if it's 60 years, but also I think your safe withdrawal rate has to be lower. Okay. Now let's try to answer some rapid fire questions regarding this, so that we can understand this safe withdrawal rate things better. So the first question is, does the income from a safe withdrawal rate system adjust for inflation? It does lah. You can see that for all of these different sequences, right, it's like all of these inflation are different. You can see that there's a certain inflation rate over here, and this puts into perspective, if you compare against off-the-shelf product, right, do they adjust for inflation or not? I'm quite sure that a lot of them, they don't adjust for inflation. They cannot promise you adjustment for inflation. This system itself, right, it accounts for inflation. That's how I'll describe it. It accounts for inflation. The inflation is different. Okay, now let's go back. Okay. So how come inflation is not fixed? Not a fixed 3%, 3%, 3% every year. Some people might have an idea that about this 4% rule, right? That inflation is like 3%, 3%, 3%. It's not. The inflation is basically haphazard. Not say haphazard, like it's based on historical. Okay, and in a certain sense, which one is more realistic? These are the actual historical inflation. This is how inflation is. It's not 3%, 3%, 3%, 3% yet. Now, sometimes in our planning, right, we have certain limitation. We cannot use this kind of like very haphazard historical planning. and we have to make certain assumptions. So it makes sense sometimes to start off with inflation assumptions of 2%, 3% and all. But I think sometimes we have to acknowledge that the actual inflation that we experience, right, it's not so fixed. Okay, so what if the duration of my income needs is not 25 to 30 years? So Bengen actually started with 25, 30 years because back then I think in 1994, right, based on the life expectancy, right, usually it's like about, you need it for about 25 years. So he's trying to see whether, in terms of optimization, what is the highest income that you can get so that it lasts 25 years and don't run out of money. Okay? But if you're planning for early retirement, let's say I'm 40 years old, right? Like conservatively, I'm trying to plan for 60 years. Then how? So you can see that from other people's work, right? It's not just because with these historical numbers, right? You can just don't run only 30 years. You can run 40 years, 50 years, 60 years. That's what Carsten tried to do. And in a certain way, even my spreadsheet itself, right, you can see that's 40 years, 50 years, 60 years. So I'm able to see that, okay, if let's say I spend 35,000, right, it probably lasts for 30 years. But when it comes to 40 years, there are certain sequence that doesn't last anymore. And we don't even have to say about 60 years. There's some 60-year sequence, right, that you will be it's rate over here, you run out of money. So look upon it as this safe withdrawal rate system as a framework, and that other people can build on to on top of it, right? It's not just a percentage itself. Give me a second. Okay, so let's go through. Okay, but how would this income stream, right? Some of you might have this question: how would this income stream, right, do in an XXX environment or situation? This is a very common, sometimes the discussion will get to a certain point, but does it factor in this kind of scenario? Like, we have never seen this kind of scenario before, right? And like high inflation, war, or let's say those kind of oil embargo, high oil prices, deflation, depression. But if you look at it, right, like the reason why we know that these situations are not good for the markets, right, is because it happened in the past. And in a certain way, right, this price information over here, it's inevitably linked to certain kind of inflation, interest rate, but also these kind of events over here. So the question you need to ask is that, what happened recently, or you think is going to happen, right, that has not happened in the past, like all these world war, like this emergency revenue act? Is there something that hasn't happened before? Because basically this framework itself, right, it factors in all of these kind of like these kind of uncertainties and all that. So okay, this is the same slide. So some questions that people have is, what if my equity and bond asset allocation is different? Now, if you look at Carsten's work over here, you can see that there's also different kind of stock allocations. You can do different, as long as you have the data, you are able to do different kind of simulation if you have the resources. Okay. Now, what if my asset allocation is like vastly different from this? Now, the important thing is that whether you have information or you have financial data to model for this one. If let's say you don't have, right, then unfortunately, this safe withdrawal rate, right, might not be very applicable anymore. But in a certain way, right, if your allocation is going to be different, right, there are a lot of things that you have to contend with as well. In a certain sense, that it's also the uncertainty of the market returns and inflation. Although you don't have the data, how your assets, your financial assets or security do in those kind of historical scenario, it doesn't mean that you are not going to be hit with it. You're going to experience uncertain returns and uncertain inflation and interest rate. That is a fact of matter, and it's a question of how do you go about creating a robust plan out of it. Okay, so we're probably like about 1 hour 10 minutes in. So here are some of my ending thoughts. If there's any takeaway from this one, right, it is that it's better for us to see Bengen's framework on safe withdrawal rate, right? The framework itself is more significant than the question of whether 4% is safe, because a lot of people will ask like why 4%, whether 4% is safe. If you just now you pay attention to my simulation, right? My simulation 4% is not very safe because I probably built in like about 0.5% a year of cost inside there, and you can see based on the data itself, right? That cost would run out of will make some of the sequences run out of money. So sometimes it's not so much about whether this is safe or not. And later on, I will have one conclusion there. I think the big theme is for us to acknowledge is that there are unique market returns and inflation sequences. You remember the part in my simulation where it's just 1 year of difference before and after, and the periods before and after you don't run out of money, but this certain sequence it runs out of money. So this is to show that like there are some unique sequences that if you use the conventional way of planning of using average returns, average inflation, right, you won't be able to actually pick these things up. Okay? We may not know our spending and longevity that well. And what 1 and 2 means is that you're going to get a spectrum of outcome. And the safe withdrawal rate, right, is just trying to be conservative. The safe withdrawal rate is trying to find the highest inflation adjusted income you can spend, right? Factor in the most pessimistic historical situation with the data available. This will also mean that if, let's say, if some people will ask, what if, let's say, we're dealing with not US data, I'm dealing with Singapore, right? Then how? And Singapore data probably we have from 1970 to today, right? That's about 50 years. That means that those uncertainty before 1970s, right? It has shorter data and it might show a higher withdrawal rate, meaning to say you can spend more. But that is because there might be some uncertainties that is not shown up in the data. So the data is kind of important, and why sometimes using US is valid because it's the longest. That Carson is using in his data is using from 1871 to 2016. That factors in a lot of kind of uncertainty that people would say about that's a different economic regime altogether. But it does show that how well it does in those kind of like volatile regimes, and this is something to be respected. Okay, it is important to know that your plan is very wrong than to know it is exactly correct. So what this means is that some people have a certain idea that, hey, my plan should be okay. I think spending 5% or 6% of my capital, right, it should be able to last. Okay? I am not sure whether 4% is safe or not. Okay? But to a certain extent, I know that if you spend 5 to 6%, right, there are some sequences out there, right, that you might not have experienced yet, right? That in those sequences, right, your money might not last so long. So sometimes I am not sure whether 2 or 2.5% is like the super safe, right? But I do know that maybe those that is like higher than that 6%, right, might not be entirely safe. And I think there's some important thing to take note of. Okay. Now, lastly, it's also that there's a lot of assumptions that is built into Bengen system, in the sense that your income is like very consistent, inflation adjusted. The question is, like, does all your spending needs to be like that or not? Might not be. And this is something that probably we can cover in other lessons, and all that. So do take note that there are certain limitations, and don't treat this one as a be all and all. Now, some questions to think about regarding this presentation over here, to think around this one, and some of them can be, I think, quite thought provoking. The first one is like, if you question, some people would say that actually like this safe withdrawal rate system is not the best, not the most robust. Then my question to you is that, if this one is not robust, right, is your preferred strategy more robust than this? And why is it more robust? And does it have enough empirical rigor? What empirical rigor means that it's actually backed up by numbers. You can see I have simulators, other people have simulators running through this one. So if you have a more robust systems, right, then you have got to show me like how does your system work and why is it more robust. Okay. Does your income needs to be inflation adjusted to this degree? Okay. Is the risk in financial independence income planning, right, similar to the risk during accumulation? So what this means is that, do you consider that the risk in this kind of like spending down your income, right, to be similar to the risk that you face during accumulation? Now, the last question is like, out of all these, right, what is the most important in income planning? Is it your rate of return? Is it your asset allocation? Is it your volatility, or is it something else? Okay, and this part would help you try to tackle like because if let's say you say some of these things are the most important, right? Then what if I tell you that is not the most important thing, and you're focusing on the wrong area? Then how would you look at some of these things? Okay, so hopefully you gain something out of this this discussion, and I hope that by the end, by now, if you manage to watch to the end of this video, right, you have a better idea about what is this 4% rule, say this safe withdrawal rate system. Does it account for inflation? How is the income progression and all? How robust this is? And everyone can critique this safe withdrawal rate system lah, but and I welcome that. But what I cannot tahan a lot of times is people having a certain idea about it. And probably one thing that I didn't cover is that a lot of people think that this 4% rule, right, this 4% is on the current portfolio value. It's not the current portfolio value. As you can see, right, it is this 4%, or in this case 3.5%, right? It's based on only the starting portfolio value. Thereafter, right, the income adjusts for inflation. It's not a percentage of current portfolio value. It's a percentage of the initial portfolio value. So there are a lot of these kind of like misconception about it, and hopefully that end of this session, all these things gets clear up. We can have a better, more healthy discussion over some of the nuances around this. If you find this video helpful in some ways, right, I appreciate if you can like and subscribe to my channel, or share this one with your friends who are on this financial independence journey, planning for their financial independence, and this might give them like some confidence that hey, there's a very simple method to actually like, or rule of thumb to actually determine whether how close you are to financial independence. Because like some crazy people out there, maybe 35 years old, right, already have 3 to 4 million, and they don't like their job, and and so and so this might give them a glimmer of hope. Hey, that like I don't have to work so hard anymore. Okay, so hope you enjoy the rest of your evening, and I'll see you in my next video.